Welcome to Financial Repression Authority's Roundtable Insight, where the best fund managers, economists, and industry leaders discuss the key investment issues and challenges in the current macroeconomic environment.
Hi, welcome to FRA's Roundtable Insight. Today is July 9th. This is host Richard Benuli. We have today Kevin Duffy and Ira Harris, and also Chief Strategist Judd Hirschberg. Kevin is principal of Bearing Asset Management, which he co-founded in 2002. He manages a contrarian macro theme hedge fund there with a flexible mandate. He's gained notoriety during the great financial crisis by betting against stocks like Fannie Mae, Bear Stearns, Lehman. He's written extensively on the housing and the credit bubble, has a passion for financial history and the Austrian School of Economics. And he has a newsletter called The Coffee Can Portfolio that we'll get into that focuses on identifying themes. Ira is past hedge fund manager and global trader in foreign currencies, bonds, commodities, and equities for over 40 years. He served as CME director from 1997 to 2003 and a stint most recently. And Judd is chief technical strategist, White Wave Trading Strategies, that will help us look at some charts on different asset classes and names as the case may be. Welcome, gentlemen.
Thank you. Good to be here.
Great. I thought we'd begin, Kevin, with your global view on the macro view on the economy and the financial markets.
Okay. Well, probably ought to start with Trump, the election. And I think there were great expectations coming into his second term. There were certainly high hopes for Doge. We had he inherited a $37 trillion debt, public debt. Of course, he contributed a fair amount to that during his first term. So there were some very high expectations in terms of dealing with that, with Doge. Also, there were hopes that the Ukraine-Russia war, that he would bring that to an end, that he would avoid wars in the Middle East, and I think investors were hopeful that his rhetoric on trade and tariffs would be kind of toned down, and that cooler heads would go in. We had quite a run up into the election, and basically, I think all of these themes have been disappointing, and that's probably putting it mildly. We have, Doge has basically been dead on arrival. Elon Musk is now is persona non grata. He was supposed to be the miracle worker. So that's gone. The trade war has been much more extreme than I think just about anybody expected. And here we are. This is the trade deadline. We're expected to have 90 deals in 90 days, and we got 2 deals, one with the UK, one with Vietnam. We can talk about that if you want. But I think basically we have a high tariff regime. As an Austrian economist and a free trader, I'm not happy when I see tariff rates going up. So this is all negative for the economy. And so basically, and then of course we still have the war in Ukraine. We bombed Iran, and it really looks like. I think the MAGA people, the populist part of the movement, was very hopeful that the forever wars would end, and it really looks like we've got kind of a neoconservative push again in terms of foreign policy and our involvement in the Middle East. So we're looking at the potential for something to escalate in the Middle East, and then on top of that, there's been a tremendous amount of jawboning in terms of Fed Chair Jay Powell. You've got people like Kevin Warsh that are waiting in the wings to kind of take over, and they think that the solution to all these things will be, printing money. So I think that's kind of where we're at, is that we have had high expectations. Everything that could possibly go wrong has gone wrong, and investors don't care. Here we are at all-time highs, and so I think there's a tremendous disconnect with reality. And then one last thing is that you do have certainly this year. I think the currency markets are starting to sniff out problems. I think the bond market's starting to sniff out problems. But really, so far at least, it's the currency markets and the gold markets and Bitcoin and that sort of thing. I think I read Fred Hickey's latest high-tech strategist, and he said the dollar index is off to its worst start in something like 5 decades. So that's kind of where we are, very much a disconnect from reality, I think.
Yeah, those are great points, macro, and we'll delve into more detail on those factors. Ira, what are your thoughts? Both Ira and I are followers also of the Austrian School of Economics, with a safety net, we like to add. Ira, your thoughts? Yeah.
Hold on, let me make sure. Well, I mean, it's just everything Kevin laid out is things to build on, of course. Are you not seeing me?
Yeah, yes, what we're seeing. Yes.
Okay.
A little bit cut. If you can move the camera a little bit lower. Yeah, slightly lower.
Okay. How about that? Does that work? No?
Yes. Yes.
I'm sorry.
Yeah.
Okay.
Yes.
I had to shift spots. So everything, Kevin, that's right. And that's where we're at. But of course, from investment standpoint, how do all these potentially play out, and how will investors, especially traders, utilize this to make money? I mean, you have to be so patient in this right now, because in a world where, happy fingers are driving so much of this, we don't have to see anything more than we saw yesterday with the copper markets. And all of a sudden you see a statement about 50% tariffs, copper prices go and rush up, about 14, 15, 16%. Now, as a trader, how do you trade that? You have to be very patient in this arena. In the longer term is, and in the broader, I shouldn't even say longer term because that gets misconstrued, but in the broader sense, how will this play out? And Kevin brings up the point about the dollar. Now, they're talking about the dollar having its worst first half in 50 years, longer, let's see, 52 years. And I think that that's a total misnomer, because in 1973, of course, that was the second leg of Nixon abandoning the gold standard. And there was another issue with the depreciation of the dollar. And more importantly, to compare those periods is really false, because you still had a lot of capital controls in place in places like Britain and other places. So it's a very difficult comparison. Is the dollar had a bad first half? I would say it all depends. I've been very bearish the dollar, where others talked about the tariffs driving it higher. I never understood that. And in that article that set everybody off a couple of days ago from the FT, they talked about how all the banks had it wrong. Yeah, there was no surprise. We did a podcast earlier with Gromer, and we were talking about how bearish we were with Bookfire. I mean, so there were people who were bearish the dollar, and rightfully so, because you can talk about a strong dollar, and Kevin's been around long enough as I have, but a strong dollar, that credibility has to be earned. And Besant has been pretty clever in the way he phrases that, because he's a believer in that too. You want a strong currency, you have to earn it through the right policies. You can talk about it all you want, but if the policies aren't right, you're not going to get it. More importantly to the weak dollar, and we'll get further into that, is that the dollar has gone down even with the EU cutting rates. Well, we had the Australians surprise the other night by not cutting. The Canadians have been cutting. People have been cutting rates. So the overnight yield differentials between the dollar and other currencies have widened, and yet the dollar has not performed well. Now, I think that that's a critical factor because, again, the dollar went up, and the U.S. exceptionalism was based on two things: yield differentials and the U.S. fiscally spending far more than anybody else. So those were called U.S. exceptionalism. Now we're seeing others who are ramping up their fiscal stimulus, especially Europe, and saw Judge charts the other day on the S&P DAX, and that put in a one-day event where the S&Ps rallied and the DAX was a little bit weak, but that's now over the last couple of days is reemerging because Europe is spending a lot of money. We've, everybody's, patting themselves on the back in the White House and in the National Security Team that they've got Europe to spend all this money on defense. Okay, so if that's what the exceptionalism is, the whole world has to be very, very, very careful, because being able to fiscally stimulus, to spend, to have rampant fiscal stimulus is far from exceptional. And I would go back and I would advise Trump maybe to read Charles Calamaris and even others within the White House, when Charles Calamaris from the via the St. Louis Fed wrote that piece about a year ago, maybe less. Yeah, no, it's a year ago for sure, on fiscal dominance. So pay attention here. Yeah, the short-term effects have been, well, this is great. There's more spending, but where it goes, we really don't know. But everything that Kevin talked about is certainly in play, and the markets had time to absorb these, and yet, yeah, we're going to make new all-time highs across the board. It's getting help from a lot of fiscal stimulus around the globe. I'm not a tariffs, to me, there's an ambivalence to some of them. Some I don't understand. How they will play out, we don't know, but they're talking about it. It's like Bessent, and Bessent is I have a lot of respect for Scott Bessent. He's kind of surprising me. He's far more political than I thought he would be. And the discussion of, well, the tariffs will collect $300 billion in revenue projected for the year. Well, let me tell you what, it comes out of somewhere. So somebody is going to get awfully wrong here, because if you're collecting that much revenue and you're not collecting it from foreign governments, there's a myriad who are going to pay for this. And if it slows the economy down, then the equity market has it wrong. But I will say this, in the short term, the weak dollar, I think, is a stimulus for the global economy, because I thought the dollar was too strong and was causing some problems, especially for the 6 or 7 trillion that are borrowed globally, especially in the so-called global South, that are borrowed in dollars. So a stronger dollar makes for a greater burden on them. So this dollar weakness actually is a short-term boost to the global economy.
Yeah, that's interesting. Thanks, Ira. Do you see that, Kevin, as those factors that Ira mentioned, weaker dollar, rising fiscal stimulus globally for increasing liquidity, is driving the markets more than any negative effects of tariffs?
Yeah, well, I'm not a big fan of stimulus. I'll say that. I don't think it worked during the COVID years. I think we're paying the price for that. I think also that when you look at, I don't have a lot of respect for the Trump economic team, Bessent, Stephen Moran. Some of the assumptions with these tariffs, and Ira's right. They're actually collecting a fair amount of money, and they probably will collect $300 billion. I've heard numbers as high as $500 billion, and that's got to come out of somebody's pocket. Now, the economic team, the Trump economic team, and I know Stephen Moran has talked about this, is that they feel that it will come out of the pocket of foreigners for the most part, and that the foreigners are basically, they have the least amount of options, and they don't have a very strong hand. I see it as completely differently. I see it as the Chinese have, especially now, every country is different. Vietnam is in a totally different situation than China is. China can basically tell us to just about pound salt. But part of the assumption on, I know Stephen Moran has talked about this, is that um, is that there would be very little inflationary impacts because the dollar, he predicted, would rally. So I can tell you that in their crystal balls, they didn't imagine rates being stubbornly high, and they did not imagine the dollar going down. This is all blowing up in their faces.
Yeah, exactly. And what are your thoughts on that, Ira? Sort of the unexpected reaction in the market stuff.
Yeah, I no. To me, again, I'll say it's bad. It's bad. There's a lot of bad policy around it, and you can tell me about this big, beautiful bill. And again, this not a word I say is politically partisan, but and I know that Kevin sits in this camp too. That I'm a sound money person. I don't say strong, I say sound, and that takes credible policy. And this tax bill, to me, is a pathetic thing. You can say this is great because tips aren't being taxed and overtimes. Okay, I'm a big believer in that. But I tell you what, with the tips not being taxed, I got a bigger problem. I won't go for the most part. I'm a big baseball fan, but I will not go to a baseball game now because they don't take cash. And to me, you're squeezing people at the bottom. You want to deal with people who are really getting beat up. There are a lot of people who work for cash. And who are non-banked, and by the Fed's own numbers, 35% of the population is unbanked. So how do you go that route? To me, there are other fixes to this than beyond that. So, and this tax bill stinks because first and foremost, instead of expanding defense spending, they should have been cutting it. And if you remember when Musk took the position of Doge, they talked about that they were going to go after defense spending. Well, I don't see any cuts there. And I'll tell you something else about the Republicans, how stupid they are. And again, that's not partisan because I'll attack the Democrats far worse. But they could have just picked up, and I heard some others talk about it of recent, but I've been talking about this and blogging, that they should have just picked up with Bowles-Simpson. And then they could have gotten this on a bipartisan basis because Bowles-Simpson was what Obama set in motion back in 2011, 2012, which was really to take on the deficit that was nowhere near out of control as it is now. And Alan Simpson, who's, may he rest in peace, whose conservative credentials are as good as anybody, was first going to cut defense spending probably up to 10% without cutting any of the muscle in the defense budget. So this big, beautiful bill, yeah, you can point to things, oh, this is good and this is good, but any bill that is that large and is so full of stuff, you can always pull out things, but I'll pull out things that are just as bad. And this is a terrible, terrible thing. And Musk is right about it, totally right about it. And whether they cut the, yeah, you're going to take away the subsidies to the EVs. I don't have a problem with that because that, again, for the most part, went to rich people who were the first ones buying electric cars, and they were getting the subsidies, and nobody on the other end were getting anything. So, you know what? Again, I think this is bad policy. If I'm wrong, the dollar will rally on its own. But right now, even with the interest rate differentials, it can't. So the proof will be in the pudding. Let's see what goes on here. And again, the weaker dollar, if the dollar went down, and I can't stand the dollar index. I would much rather do it on individual currencies and the way I look at things and currency cross rates. But I'll be watching this. But if the dollar were to close out the year 20% lower, then all these tariffs are superfluous anyway. Because and Kevin's point again with what Marin talked about, I know, and everybody bought into the dollar was going to rally. I didn't, because I think the policies are so they're in disarray. There's really no solid policy. And when I listen to Besant, he knows it. And when they ask him about a strong dollar, which is of course a mantra that goes back to Bob Rubin for certainly when he was Secretary of Treasury, if not before. It's based on quality policy. Right now, I don't see it. If the dollar really starts to rally, then I'll say, okay, I'm wrong. But as of this juncture, I don't see it. And if the dollar rallies on top of tariffs, then I think the global economy will go into a major, major slowdown.
What do you see, Kevin, for the trends unfolding like the rest of this year, the trends on the dollar, the economy, the financial markets, S&P 500?
Well, I definitely agree with Ira about military spending. I think that this is really the litmus test. And back before 9/11, we had less than $6 trillion in public debt. Today we have $37 trillion. Back before 9/11, public debt to GDP was 55%. Today it's 123%. This is in peacetime, supposedly. We've never seen anything like this. Interest payments were 14% of tax receipts when Trump 1.0 took over. Today they're 22%. We have $10 trillion in debt rolling over this year. Interest rates are stubbornly high. The average maturity on the debt is something like 5 or 6 years. It's basically checkmate. And the only way out of this, to have any kind of a serious conversation, in my opinion, the military-industrial complex, it really needed to go away after World War II. That didn't happen. We had the Cold War. Okay, it really should have, and then we fight the Cold War with the Soviet Union. The Soviet collapse in the early 90s. Again, it should have gone away. That didn't happen. Instead, we get NATO expansion. Okay, and then we have 9/11, and we have the quagmires in Afghanistan and Iraq, and we had the neoconservatives who were in George W. Bush's administration, basically running things. What is really terrifying today is that we haven't learned a thing, that these people, the neoconservatives now, and when I look at what's going on in the Middle East, it's the same people that created all the messes that we've gotten ourselves into. They're the ones that are calling the shots. And I think what we're going to see, I think it's a fascinating time because, number one, the people, there's a big difference between the people running things and the people. We have this populist movement, the MAGA movement. Big difference between the leadership and the people. Let's face it, who really runs things? It is the deep state, the bureaucracy, the military-industrial complex. And I think that a lot of people on the right, on the populist right, got their hopes up because they thought that Trump actually represented a change and a pushback from really 2 decades of quagmires in the Middle East. And what they're finding right now is that he's basically just like the old neocons. And so I find it interesting because, number one, we could get a split in the MAGA populist movement. And when we do that, all that will be revealed is the neoconservatives and the military-industrial complex. And we'll kind of lay bare the root of the problem. And I really do believe that that is the root of the problem. And that until we address that, we're really not, we're just fiddling while Rome is burning.
And so would that entail like continued lower dollar, rising inflation in order to inflate away the burden of the debt?
Well, the thing is, all of these problems, okay, Trump not only inherited, but he helped cause, okay? $37 trillion in debt from my calculations, 10 trillion of that is on his watch during the first term, okay? And so, and I'm including the interest on that. I think it was 8 trillion, maybe added a couple $1 trillion in interest, all right? So it's not like he has his hands clean in all this, all right? But he, quote, inherited a bad situation, really next to impossible fiscal situation. And he had to do everything perfectly. He had to, kind of thread the needle, run the gauntlet. He had to do everything perfectly. And there was no room for unforced errors. And what we're seeing is we're seeing not only a continuation of the old errors, but we're seeing new unforced errors. When it comes to trade, this is a disaster. I think the trade situation, and what people don't understand is that this was telegraphed. Okay, so if you look at the inventories of retailers, they stocked up on inventory ahead of all this, right? Now, those inventories, I believe, have been largely drawn down at this point. Okay, so the consumer so far has been somewhat insulated by the effects of these policies. Okay, but the average tariff rate, the Chinese. Okay, so last year, I believe we did. Was maybe I think it was $1 trillion in trade. Let's see, I've got my got some statistics here. The crazy thing is that the trade deficit has actually gone down. It peaked, the trade deficit with China peaked at $418 billion in 2018, and it was under 300 billion before this trade war this year. Okay, so I mean, there has been progress made, and there's all kinds of fallacies in terms of unfair trade with China. But and the other thing about this so-called deficit. So we run before this we ran a $300 billion trade deficit. Okay, U.S. multinational companies do something like $500 billion of business in China. If you go to China, you'll see, there's Pizza Hut, Starbucks everywhere. I mean, it's been open for business. So I think there are, that is a tremendous amount of, we know as economists, the trade is win-win. And what's taking place is that companies that are doing business, Nike is getting Nike, Apple, Tesla, all these companies are being hurt in China as a result of this. You look at Trump's first trade war. The Chinese reacted to that. Okay. Also, you had sanctions against Huawei, and they tried to put Huawei out of business. Well, what happened was the Chinese people rallied around their own homegrown technology companies. China was perfectly content to buy American technology, but they realized that this was an existential threat. And so, people, when you abuse people, they don't just sit there and take it. These are not stupid people. All right, do a Google on IQs around the world. Guess where the smartest people are? They're in Asia. Okay, they're graduating STEM graduates far more than we are. All right, so I don't think people understand how far China has advanced technologically, and that Trump actually boosted all this. So what's happening is all of these policies, okay, all these interventionist policies are having the exact opposite effect that they want to have. And if I look at these policies, to me, the main driver of these, I think there are two, like you think about protectionism, the good old days of protectionism, back in the 70s, back in the 80s, you had all these small Japanese autos coming in. Who was crying wolf? Who was complaining about unfair trade and all the rest of it? It was Chrysler, it was Lee Iacocca, it was all these people that were, having to compete with the Japanese, all right? Typical, that's your classic protectionism. What I find interesting about this current protectionism is that you don't have those narrow interests that are out there jumping up and down asking for protection. In fact, you look at the auto companies that Trump has basically been trying to support, and they're saying, no, thank you. You're hurting us from all this. So I think the two main drivers are the populist movement behind MAGA. They honestly believe that protectionism is going to bring manufacturing jobs back to the United States. And I think that they feel that that is going to improve the situation. But I think, and as I said earlier, the MAGA movement is starting to fracture. Okay, so that's something, an interesting aside. But I think at the end of the day, what's really driving this? It's the military-industrial complex, because they see the rise of China as an existential threat. They see anybody's. It doesn't matter whether how they got there. The fact that the Chinese have succeeded, this doesn't sit well with the military-industrial complex, and so you have different drivers of all this, and I don't see it. I don't see it ending well. But like I said, I do believe that at the end of the day, we are going to learn some very painful lessons in trade. The average tariff rate on Chinese imports today is now 51%. The average Chinese tariff rate on U.S. goods is 32%. So, you're going to lower the volume of trade is going to go down dramatically. And if trade is win-win, then that can't be a good thing for the economy. And it's certainly not good for the American consumer.
Wow, yeah, that's a lot of great insights. Your thoughts, Ira?
Well, let's go back to the question. And as Kevin points out, you're piling on this debt. And again, I go back to Bowles-Simpson, and that's where the Republicans are remiss, because they could have just called this Bowles-Simpson 2 and say, this is the route we're going. We believe that was the right policies. There were a lot of good things in there, some aren't, and we could have adjusted it. But we've built on, as Kevin points out, debt on top of debt on top of debt. And for these idiots who talk about, well, I'm going to cut interest rates. Well, the real impact, if we're right, will be a radical steepening in the curve, because you may have, and Jimmy Bianco's pointed this out, and it doesn't take any great deep analytical thought here. The curves will steepen. If you were to cut interest rates 1% tomorrow, I'll bet the 5 in a week's the 10-year in a week's time will be over 5%, because the markets will be getting nervous, because the response is, how are you going to respond to whatever you're cutting the rates to? And as we started out this conversation, how are you going to pay this off? And that's where Kevin goes. And it is, because the military, and that's why Alan Simpson was so powerful in that Bowles-Simpson group. And it was really too bad that Obama got cold feet about it and didn't want to take on the powers, because the right people were sitting there. Erskine Bowles, certainly a power within the Democratic Party at the time, and Alan Simpson, highly respected in the conservatives group. And if he's willing to push for that. Now, since that time, all we've done is throw on more and more debt. Now, COVID and other things, and the way that, we go back to, the whole concept of financial repression. And we'll dig into Rogoff and, of course, Reinhardt and their book, This Time Is Different. And what was their solution is that you were going to run higher inflation once you got over 95%, because a total debt level over 95% eventually eats into economic growth, as you have to pay it back. And we can get into whether it's Ricardian equivalence. I know for some people that they don't like that term. It doesn't bother me. I think there's a lot of truth in Ricardian equivalence, but you have to, as Keynes said in his wonderful tract, 1923 tract, and I've talked about it before, so if you're bothered by it, too bad. But in monetary reform, there's 4 ways to deal with excessive debt. Number 1 is repudiation. Well, that ain't going down very well, because once you get to that point, gold will probably be at $10,000. And I just throw that out as a number. It's meaningless, by the way, but it's a good headline. You can depreciate the currency. You can devalue the currency, because depreciation is a slow process. Devaluation is a quick process. Or in Keynes's fourth way, a capital levy on all wealthy people, if you're so worried about the debt holders, and as Keynes said, euthanize basically the bondholders. So So a capital levy, when we brought that up in the Luke went white because nobody wants to go to a capital levy because we know what that means. So it's repudiation of depreciation of valuation, and you keep building upon it. That's what the problem with this tax act was. And you can abstract out whatever you want. You are still left dealing with it. And as Kevin points out, as he did several times, the cost of covering this debt is just growing and growing. And it is. And I've been on record for years already talking about it. That once the interest on the debt exceeds the defense budget, you're in serious problems anyway. Right now, Wall Street and others, they're feeding off. I think number one, the weak dollar, and number two, the massive amount of fiscal stimulus that's taking place globally. So we're still riding that. How long will we ride it? Maybe a day, maybe a year. I don't know, but we will come to meet it. But it always ends in what Carmen Reinhardt, outside of Rogoff, has done phenomenal work on financial repression. And of course, we always go back, and more gets talked about it, the 1951 Accord. So read your economic history and see how these things are resolved. And Trump coming out today talking about, well, if you would cut 3% interest rates, you would lower the cost of the financing deficit $360 billion. Well, that number is so wrong because that assumes that everything is financed in short-term instrument, and then you're going to crush them. But again, you want to see gold rise, you want to see the dollar drop, do that. Because when you've gone down that path, you've announced that we're going to just appreciate the shit out of our currency. You're not going to see it right away, but that's going to be the ultimate end of it. And where the dollar is at right now, where are we at in the dollar index? 97, 97.30? Well, that's nowhere near. We were down at 70, I don't know how long ago, 15, 16 years ago. So you can look at the dollar index on a monthly, please, we're nowhere near. And if the dollar, you want to depreciate the dollar, then stop talking about tariffs because you won't have to do it. Just invoke policies that'll lead to dollar weakness, and you'll get the impact that you want. It may take a little longer, but you will get that impact. You don't have to do both. But again, it's this reckless spending, and it's reckless because again, where did Musk come in? He said, we're going to cut defense. So you go look at what Doge said at the beginning. Yeah, there's plenty of room to cut in defense. And Kevin, again, is exactly right. And this is why I've always, I'm 72, for 50 years, for certain, I've been on the basis of I'm an anti-deficit person, especially because the deficit drives the defense spending drives it. As Kevin points out, we'll go back to Eisenhower and what Eisenhower warned about in his farewell address. It doesn't take any genius. I can go back to 1896 and reread the speeches of William Jennings Bryan. This has always been an issue in the United States about what you do with the debt and the deficit. And there's inflationists, and there's those who were, of course, the New England and the Boston Brahmins, who were sound money people. Why? Because they own the bonds. And if you're a bondholder, you want sound money policies. The worst thing that happens to you is terrible monetary policy that drives inflation, that weakens your holdings, your assets, which are bonds. So this is where we lie, and this ridiculous 360 billion is just far wrong. And the fact that Percent didn't call Trump out again, and I've always been a fan of Scott Percent in the realm in which he lived in, which is global macro, but he's very political here, and especially by not calling Trump, because that's just so totally wrong. And if you're going to drive rates down, then watch for the outcomes of it. But again, I'll go back to Kevin. Because the defense budget has been sacrosanct, everything starts there because everybody wants a defense plant in their district. It's good jobs, it's good money. And once you sign on to that, then the log rolling begins, and I'm willing to do trade-offs. That's why Alan Simpson wanted to cut the first thing he wanted to do on Bowles Simpson was cut the defense budget.
Meet the Cedar Owl, a new economics and finance publication with a focus on environmentalism. We combine the Austrian School of Economics and market environmentalism principles for investing in a sustainable future. Follow the link in the description to get to know the Cedar Owl better, understand our values, our mission, exactly where we're coming from, and the type of content that we release on a cyclical basis every Thursday. Join us in targeting outperforming portfolio returns while making a positive impact on society and the environment through technology. Subscribe now for weekly insights, investment articles, and exclusive content.
Okay, where would we go from here, Kevin? Like in terms of, do you see the same tools of financial repression being employed, and how does that actually factor in your investment philosophy with the coffee can portfolio that you have?
Right. So, I try to focus on, the big trends, and I think of we've got positive forces and we've got negative forces. And I think of the positive forces. There's a great quote by Bill Bonner, and it's something like this. When it comes to science and technology, man learns. When it comes to love, finance, and war, he makes the same mistakes over and over again. And so the pattern on the positive forces tends to be innovation, technology. The pattern in terms of financial markets on the negative side tends to be collective delusions or bubbles, whatever you want to call them. Okay. And so I look at, we have countervailing forces. Okay. So I think what I try to do is not focus on just all the negatives. And I want to look at the positives too, if anything, just to maintain my sanity. But I think also as an investor, I'm looking for positive things going on in the world. Okay. And so, and I'm also trying to do this before everybody else figures it out. Okay. So you could look at, in terms of the negative forces, it's kind of like, you want to grab the oxygen mask. But, if the plane is going into a deep dive and everybody's panicking and they're all scrambling around looking for oxygen masks, you're going to have a hard time and so on the positive side, it's skate where the puck is going. Okay. But you want to get there early. If you get there late and everybody's skating in the same place, there's not a profit opportunity. All right. So, what I try to do with the coffee can portfolio is to kind of step back and look at things from, 40,000 feet. And because I will say that, in my lifetime, it's been a pretty remarkable time when I think about all of the technological progress that's taken place. We were in the early stages of the information revolution, and I witnessed the PC, networking, the internet. Now we're into AI. It's been, there's no question that there's been progress that's taken place. Okay. And we can talk about all these negative things, but we have to sit back and acknowledge that these positives have taken place, because it probably never would have gotten to $37 trillion if we didn't have these positives going on. So the big positive, certainly technology, and I don't see that ending. I see that continuing. You could make a case that AI is a bit of a bubble right now and, probably go through a shakeout or something, and that there's malinvestment there, to, use the Austrian term. Okay, I get all that. Okay, so there's your positive force. But to me, the big positive force has been that when you look at the Industrial Revolution, where did it take place? It was in Britain. It was in America. It was in the West, what's considered the West. It was very unevenly distributed, okay? At the same time, you have this rise in centralized government, okay? I mean, it started here in 1789 with the Constitution replacing the Articles of Confederation, in my opinion. And the South tried to secede when it felt like it was being abused, and that didn't work out. So the centralization trend continued. But the gains, so the gains from the Industrial Revolution were not equally shared. It was the West, and at the same time, the West that really benefited, but at the same time, the West also became more militant. It became more imperial. You had these imperial powers. And in the West, I also include, later on would be Japan. And you look at a country like China that did not develop, along with the West, and they had to endure in the 19th century, the century of humiliation. You had the Opium Wars. You had basically they lose Hong Kong to the British. They then in the late 1800s to World War II. They're basically now you have the Japanese attacking them. They actually occupied Formosa, now Taiwan. Many people forget about all these things, but the Chinese endured a tremendous amount, and then of course they had their own self-inflicted wounds with Mao and the famines and everything. But the Chinese changed, and they learned. They not only learned from their own mistakes, and they also have a deep fear, an existential fear of Western powers. And like I said, they're very resilient people. It's a huge country, very entrepreneurial people, very smart, hardworking, all these things. And so I think what we've seen here is we're starting to get a reversion to the mean, where it's not all the economic benefits don't just accrue to the West. So the West has become complacent because they felt like this was going to go on forever. But of course it didn't. Nothing goes on forever. And the rest of the world starts to catch up, and the leader there is China, I think, in many ways. And the Chinese, they have learned. They learned from their own mistakes. They learned from being closed off to the world. They understand the importance of openness. They understand the importance of free trade. They are the leaders in free trade around the world. I mean, all this nonsense about the Chinese having trade barriers and everything, it's completely ridiculous. So you can do a Grok search. Ask Grok what was the average tariff rate in China in the 1990s. It was 32% in 1992. In 2022, 30 years later, it was 2.2%. Okay, so China has experienced. They have learned they have prospered by actually lowering tariff rates dramatically. Whereas we have sanctions on a lot of poor countries around the world, the Chinese are open. They have zero trade barriers, zero tariffs on all emerging economies. Okay, so this is, to me, what is really interesting about the world that we live in is that the West kind of got fat and happy and complacent, and they're now in a lot of ways destroying themselves. And the Chinese, and I'm not saying the Chinese model is perfect or anything. It's not. Austrians are not going to not going to jump up. It's this is just do backflips about how free market they are, and there's no central planning. I mean, we can come up with. There's certainly negatives about the Chinese, but the Chinese have a long history of peaceful coexistence with their neighbors for the most part. They are, like I said, they are championing free trade. They have no interest in getting sucked into the Middle East militarily. The military buildup there is because they're encircled by the United States. We've been arming Taiwan right on their doorstep. So I see a lot of positives. And the other thing, this is to me the cherry on the sundae, is that there's always the narrative. And the narrative, like as an investor, there has to be a dedication to reality at all costs. Um, and so how do you get to the truth? And it's not just the truth that we're after, but it's the truth ahead of the crowd. If the crowd believes something and they're totally wrong, and we can write that, I think it gives us a profit opportunity. So, all right, if you want to get to the truth, let's go to the known liars. Who are the biggest liars on the planet? Well, the mainstream media, we can put them in that category, and the military-industrial complex. Okay, well, what is the mainstream media and the military-industrial complex telling us about China? All bad, all bad, all bad. Okay, so I started as when Chinese stocks tanked several years ago. I started to get interested just as a contrarian. And the more I dug into this narrative, the more I realized, you know what, a lot of this stuff, it's basically you can trace it back to press releases that come out of the Defense Department. And everybody takes this stuff as gospel. So I think that China is cheap. I think the Chinese have largely learned a lot of good things about American style capitalism. Again, I don't think it's a perfect system, but and as an investor, I always like to say it's a market of stocks, not a stock market. I think we're up here at this big macro level, which is great, but you still have to get down into the weeds, and you still have to look at businesses, one company at a time. And what you see is in China, they have adopted very shareholder-friendly practices. They're profitable. These are profitable businesses. They're generating, plenty of cash, free cash flow. The stocks are dirt cheap. They're now taking these free cash flows and buying stock. You have, high levels of insider ownership. There's just, as an investor, just looking at businesses and a culture, I get excited about China. There's a lot there to like, but that's, to me, skating where the puck is going. To me, it's all about Asia. That's the future. I am not a fan of what's going on in Europe. I mean, we can come up with a list of problems that we have in the United States, all the wokeness and everything. And I think a lot of these problems are much worse and more advanced in Europe. So I'm not, totally negative on American ingenuity. There are lots of opportunities here in the United States, but you have to go through kind of stock by stock. And of course, as far as grabbing the oxygen mask, gold stocks have really lagged. Well, they've caught up somewhat this year, but there's still a lot of interesting ideas there and selling at very reasonable prices and price to cash flow. So there's plenty to do. I don't think you have to focus on all the negatives.
Mm-hmm. Oh, that's
it's
great.
A little long-winded, so.
No, that's very good information and overview analysis. I guess, your thoughts, Ira, for investment themes as well.
Yeah, I didn't want to jump in. So Kevin makes an interesting point about where Chinese tariffs were in 1992 and how they've come down. But when we talk in that regard, you have to take into account in 1994, January 1st, on the day that NAFTA started. I'll say this again, it's amazing that people in the public policy arena don't say it. What did China do? They depreciated the currency 50%. The yuan went from 5.8 to 8.7 January 1st. So as the currency has sat within a range, I would probably say from 5.9 to it sat up there at 8.7 for quite a while. The Chinese have been able, with a weaker currency than they had, to over time, of course, bring down their tariffs. And this really bodes well for the argument that I make, that if you let currency levels really get to where their underlying fundamentals were, now China's fundamentals weren't, but they were trying to upset the world, and they did, because 1997 July 2nd, 1997, the whole Asian contagion blows up as Thailand devalues the baht. So you have these things that take place, and then things are reordered. But when Kevin talks about Asia, there's no question. One of the plays that I've tried to make is to be along UBS, because once UBS got rid of their Goldman model of wanting to be a hedge fund, they're set up for wealth management. And as we were on last week, Kevin, I did with Richard, we did a podcast with George Magnus, and I think George Magnus really set UBS up to be in Asia. He's been gone since 2016, and UBS has had its problems. But it's interesting today that UBS is actually making multi-year highs today as we talk. But UBS is set up to do wealth management in Asia. Singapore, and I had actually when I was on the CME board, I actually got to talk with Lee Kuan Yew's son when he came through Chicago back in 2002. And he had said that Singapore was trying to position itself as the Switzerland of Asia by building up its banking and being, wealth management business. I don't know whether they're going to make it. One of the things that I love in Asia is, of course, still, and I talk about it quite a bit, is Tokyo Mitsubishi, because I think Tokyo Mitsubishi, with Japanese aging, that's perfect to be a high quality wealth management institution. And the fact that Tokyo Mitsubishi also owns 22% of Morgan Stanley, that's a powerful combination if they'll put it to work, because that's where the wealth creation is really taking place across Asia. And you can really set yourself up. So as Kevin talks about, getting there first. Yeah, I agree. But again, if you do your global macro homework, that doesn't mean that that these are all going to pan out, or they're going to pan out in the timeline that you're managing. But more importantly is how to manage your risk in search of that, right? As long as we're using the hockey analogies, you don't want to get off sides. You want to skate to where the puck is going to be, but you don't want to be off sides. And the off sides means that you don't understand how your risk management plays out. But these are things that we've been talking about. So yeah, I keep searching for things in that. Canada is interesting to me. If Mark Carney could get the monkey off his back of trying to placate the world with the bullshit, and I'm sorry but I can't, of the World Economic Forum and that crowd with carbon, they're not going there. As yesterday, Doomberg had a beautiful piece about how the Chinese are burning more coal while they talk a green, but they've grown their coal. Deal with the world as it is, not as you wish it to be. And the problem with Trudeau, he was so caught up with his own BS, that he took China, but if he took Canada, but if Canada, you look at what Canada is. Canada is Siberia, but with greater population, a much better education system, and the ability to really supply the world, not just with raw materials and commodities, but with intellectual property to go with it. There, again, get yourself wrecked. So I'm watching Canada closely here. Canada, because the currency to me is really cheap. I mean, we've seen, in speaking of futures terms, we've seen the Canadian dollar, and we'll speak in dollar Canada. We saw the dollar Canada down at 90, about 15, 16 years ago. And we've seen it up recently at 160. Now it's where? 137. I mean, are Canadian assets cheap? If you're looking for energy, Canadian assets are cheap. But you have to have a government that's willing to work with you. And I think one of the better things going on in Canada is that the threat of secession from Alberta, just like we saw many times with the Quebecs running those referendums, there's so much going on there. They have the rare earths that everybody's looking at. Yes, they're the U.S. biggest trading partner, and Lord knows why Trump threatens Canada. Uh, he should be working with them as others are. And Europe has a great opportunity here to work with Canada because Canada can ship energy from either the eastern seaboard, which is the Atlantic, or more importantly, they get a straight shot into Asia, right? You don't have to go through the Panama Canal. There are no, yeah. There are not those choke points. And let me just end where Kevin talks about the world is, the United States, when it proceeds along things, it thinks that, well, our models tell us this, and these will be the outcomes. I'm sorry, the world is neither linear nor static. And nobody's waiting for you to kick them in the teeth and go, oh, yes, sir, may I have another? They're moving. And we saw that with the Russian sanctions. And I've had some vertigo, so I've been struggling a bit, but I'm almost done with that book by Fishman called Choke Points. I would advise you to read it. Not that it's perfect, but it breaks up the world. Now I'm finally into the Russian-Ukrainian situation. But, you can applaud and pat your back that sanctions work. But I know that Cuba is still standing. Yes, they affected Iran, but Iran put itself in a very difficult situation. Did the sanctions work on Russia? I would argue not, because the Indians have been buying massive amounts of Russian oil, refining it, and reselling it, just like the Chinese can. So if I can buy a discounted product and make money on it, the hell with you. I have to satisfy my economy. And yeah, you may choke me out of the dollar system, but that ain't working so well anyway. And you can only play that game up to a certain point. So these guys like Dalip Singh and others who pat themselves on the back as being so brilliant, I don't think so, because it has not played out in a linear straight line whatsoever. And I think that's a very important aspect. And as Kevin thought, nobody is waiting for you to kick them, to be beaten on, and they're moving, and every time you play a hand and it fails, you put yourself in a tougher situation. So I agree with Kevin. We're going to skate to where the puck is going to go. We don't want to get off sides by taking on too much risk, stupid risk. You do it in a fashion, and with all of these things in play, yes, I think there are a lot of potentials out there, and I think Europe is now. And look at the DAX is making all-time highs today. I think that's right. Judd will verify. But I think that after struggle,
I think I just kicked Ira off.
So
there he is.
There he is.
Oh yeah.
So I mean, you can see it, but going back to Europe's got multi problems. But Kevin, I would say that Lagarde, who's a politician more than an economist, and a strong politician, a weak economist, but she sees it in her continual beating on a capital markets union. If Europe could actually put together a capital markets union, because they, as we know, and Europe did it all backwards. They came with a currency first, where you should have come with a capital markets union, a fiscal union, and then the currency would follow suit. But they were in such a hurry because they had allowed Germany to unify. So that changed the whole nature of it. So, and they've been suffering under it. But if they can create a capital markets union, I think Europe will outperform in the short term. Yes, they have the massive problems of the US, but they also have Germany. And proof to this, I will, this is my last thing I'm going to say. Proof to it, watch the Swiss currency. The Swiss currency is down to zero rates, negative, going out 2 years. And why? And I would argue because that's the barometer, because they're in the best situation of anybody on the debt to GDP ratios. So the world is rewarding them, even though the Swiss are going, please don't reward us so much because you're driving the currency too high. But it's a very good barometer for judging where the world's focus truly is.
Oh, wow. Great insights, both Kevin and Ira. And just wondering your final thoughts, Kevin, and also how can our listeners and viewers learn more about your work in the coffee can portfolio?
Sure.
Yeah.
Just go to my website. It's thecoffeecanportfolio.com, and I write about not only macro issues but also manage a virtual model portfolio in real time. Also get into discussions like portfolio construction. So I'm really trying to look at things from multiple perspectives. Not just as a macro economist, but also from the perspective of a portfolio manager, and also have a set of rules on my website. A little like it's a market of stocks, not a stock market. Um, uh, Adversity spares the robust and takes the fragile. Um, so it just but basically what I'm trying to do, I guess, just to sort of wrap things up, maybe a kind of a final thought here is I think of investing um, as a game. Um, it's serious. It's not a game. I mean, but it's a competition. And so, and I think, we all have our strengths and weaknesses, and there are, many different paths up the mountain. There are many different ways to compete in this immense game that we have. It's hopelessly complex, incredibly, just immense. And so, what I'm trying to do is get people to think in terms of where can you get an edge in the game? And there are, multiple types of edges, but I think you can basically group them into three categories. One is an informational edge. So you build a circle of competence and you find areas that you're interested in or that you do well. The second type is behavioral edges. So trying to avoid binary thinking, trying to avoid uh, running with the crowd, try to avoid confirmation bias, things like that. The third type of edges, I think, are framework edges. And so having a sort of an intellectual framework to deal with the real world. And so my framework is the Austrian framework. Really, it's a non-interventionist framework. So, when I am looking at history, or if I am looking at the history of conflict in the Middle East, or I'm looking at responses to COVID, I'm looking at that through a lens. And I'm looking at that through the lens of being a non-interventionist. And basically, what I believe is that there is a natural order out there, and the best thing that we can do is leave it alone, and it'll take care of itself. The worst thing we can do is try to manage it from the top down. And so, as an investor, that framework, and I think the advantage is that most of the people that we compete with are establishment investors. They tend to be interventionists, economic interventionists. So I do believe that framework edge is an enduring edge, or it should endure certainly in my lifetime. I don't expect that to, if Austrian economics becomes really popular, then we may have a problem. We could have another discussion, but
Yeah, not sure. I might have froze there. Kevin. Yeah. Okay, I guess, and Ira, if you could provide your final thoughts and how can our listeners, viewers learn more about your work? Yeah.
Well, my work can be found here as, I'm not really blogging much anymore. So it's not out there as much. I don't like to respond on X or other places. If you have real questions, we can discuss them. But I'm with Kevin. That's our job. My job at the end of the day is, Kevin must have left, but is to make and find profitable investments and trades with the lowest amount of risk. That's what I search for. And I'm a trader. I'm a trader first and foremost. The investments, as we've talked about over time, I think we've had some very, very, very good investment ideas over the last 5-6 years. My whole life, but where I've really been availing of this. So that's what I seek to do. And you know what? And my strength is trying to be a political economist, because those who are just economists and operate on economic models, I think, miss a lot. So combining, and I hear it in Kevin, is that you want to be a political economist and look for the things that are taking place. But, that's why the dollar as a tool of statecraft, as Mike Every might say, is an important way to measure it and to see, and then to look to fallouts from that. Changes in policy, like we're going to, that we're potentially hoping to see in Europe. I think people are ahead of themselves here, but it's driving the market. So, I don't care. It's been a very good, I've been, preaching the benefits of Commerzbank for other reasons. But if that capital markets union comes into being, there are certain banks who really stand well, because again, the EU has demanded and will demand that if you want to partake in their broker bond model, that you're going to have to be domiciled there. So that puts some added value into some of those domestic banks, which comes out of a macro framework. So it's the way I look at the world, and I can tell you that I agree with Kevin. It's how do we do this and take and with the least risk for the greatest reward. That's what we're always searching for. And if you're not using this for money making ideas, then you may as well turn on CNN or Fox, and go play with yourselves. But this is to try to generate, ideas. And the last thing that I'm looking at is, as people deal with Trump and the tariffs. So I'm watching very carefully. I was right for a few days last week, but I'm dead wrong now. But it's hard for me to believe that some of these people who Trump is pressuring with tariffs don't reach a new trade deal with the U.S., especially on the ag sector. I think this is very important. And Trump is all about wins. If you give him a win, he'll give you something. So there's always a get with him. Figure out where you can get a give for the least amount, and maybe even make money while he gets a get, and then he can parade around going, see, I told you to get tired of winning. It's nonsense. I don't even know what winning is. But if that's the way that your counter force works, then find ways to do that. I look back to the wheat deal of 1972, when the U.S. made that big trade, and they were doing it to help the heartland in Middle America. It raised food prices and farm prices dramatically, and the Russians made a boatload of money because they re-exported that wheat and made money. So I don't know, why somebody like Japan wouldn't say, okay, we'll buy up all your damn soybeans, we'll process them and resell them around the world. The same thing that India and China have been doing with Russian oil. And you give Trump needs a victory for the heartland badly. So I'm not telling you it's going to take place, but I'll be watching certain things that'll tell me. Is it going to happen? I don't know. But from a geopolitical standpoint, from a political economic standpoint, sure makes sense to me. And I will look for it and hopefully be in a position to take advantage of it, if, and I stress, if it does happen.
Mm-hmm. Wow, great insight, observation by both Kevin and Ira, and charts by Judd. Judd, if you could display your contact information on the screen. And thanks very much, everybody. Kevin, Ira, and Judd. Thank you for this discussion. Thank you.
Thanks, Kevin. It was a pleasure.
Thanks. Enjoyed it, Ira.
The FRA Roundtable Insight Show is for informational and educational purposes only and should not be considered as a solicitation or offer to purchase or sell any securities. The investments, investment strategies, and investment philosophies discussed or presented on the show each involve their own unique risk factors which are not discussed on the show. Any discussions among the panel participants or responses to listener inquiries are based on the personal opinions of the panel participants and do not take into consideration the listener's suitability, objectives, or risk tolerance. Please be advised that you invest or speculate at your own risk.